Question 1. Benchmark analysis indicates that a closed-end fund is being offered in its primary market in Ontario, Canada, at an initial public offering (IPO) price. A registered representative is considering recommending this fund to a client. Which of the following approaches best ensures compliance with regulatory requirements and ethical obligations in Ontario? Option A. Recommend the fund to the client, emphasizing its attractive stated dividend yield as the primary benefit without detailing its IPO distribution or subsequent exchange trading. Option B. Present the fund to the client as a stable income-generating investment, focusing on its NAV and downplaying the fact that it will trade on an exchange where its price can fluctuate. Option C. Advise the client that this closed-end fund is similar to an open-end mutual fund, highlighting its NAV and suggesting it offers comparable liquidity and pricing stability. Option D. Fully explain to the client that the fund is being distributed at an IPO price and will subsequently trade on a stock exchange, detailing the potential for its market price to differ from its net asset value, NAV, and outlining the associated risks. Correct answer is D. Fully explain to the client that the fund is being distributed at an IPO price and will subsequently trade on a stock exchange, detailing the potential for its market price to differ from its net asset value, NAV, and outlining the associated risks. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to navigate the complexities of a closed-end fund's initial public offering, IPO in Ontario, Canada, while ensuring compliance with regulatory obligations and client best interests. The representative must understand the unique characteristics of closed-end funds, particularly their distribution in the primary market at IPO price and subsequent trading on an exchange, and how these differ from other investment vehicles. The challenge lies in providing accurate and suitable recommendations without misrepresenting the fund's nature or potential risks, especially when dealing with a client who may have limited understanding of such products. Correct approach analysis. The best professional practice involves thoroughly educating the client about the specific nature of the closed-end fund being offered in its primary market. This includes explaining that it is distributed at an initial public offering, IPO, price and will subsequently trade on a stock exchange, where its market price may deviate from its net asset value, NAV. The representative must also clearly outline the potential risks associated with both the IPO subscription and secondary market trading, such as the possibility of trading at a discount or premium to NAV and the liquidity of the secondary market. This approach is correct because it aligns with the regulatory requirement in Ontario to ensure clients receive full and fair disclosure of all material facts, risks, and characteristics of an investment product before making a decision. It upholds the ethical duty to act in the client's best interest by empowering them with the knowledge to make an informed choice. Incorrect approaches analysis. Recommending the closed-end fund solely based on its stated dividend yield without detailing its IPO distribution and subsequent exchange trading characteristics is professionally unacceptable. This fails to provide a complete picture of the investment, potentially misleading the client about the nature of their investment and the factors influencing its value. It breaches the regulatory obligation for full disclosure and the ethical duty to avoid misrepresentation. Suggesting the fund as a guaranteed income stream without explaining that the market price can fluctuate and may trade at a discount or premium to NAV is also a failure. This misrepresents the investment's risk profile and could lead to client dissatisfaction and potential regulatory action. Furthermore, presenting the fund as similar to an open-end mutual fund, focusing only on its NAV without mentioning its IPO pricing and exchange trading, is misleading. This comparison ignores the fundamental difference in how closed-end funds are structured and traded, failing to provide the client with accurate information necessary for a suitable investment decision. Professional reasoning. Professionals should adopt a client-centric approach, prioritizing education and transparency. When recommending any investment, especially one with unique characteristics like a closed-end fund at IPO, the process should begin with understanding the client's financial situation, investment objectives, and risk tolerance. This understanding then guides the selection of suitable products. For closed-end funds at IPO, the representative must proactively disclose all relevant information, including the IPO price, the fact that it will trade on an exchange, the potential for price divergence from NAV, and associated risks. This proactive disclosure, coupled with a clear explanation of how the fund operates, empowers the client to make an informed decision and ensures compliance with regulatory and ethical standards. Question 2. Quality control measures reveal that a registered representative in California, who is licensed to sell securities under FINRA rules, has a client who is the CEO of a publicly traded company. The CEO confides in the representative, stating, "I can't tell you this officially, but our company is about to announce a groundbreaking new product that will significantly boost our stock price. I'm thinking of selling some of my shares before the announcement." Which of the following represents the most appropriate course of action for the representative under the Securities Exchange Act of 1934? Option A. Report the CEO's statement to the Securities and Exchange Commission, SEC, without further discussion with the CEO. Option B. Execute a sale of the CEO's shares immediately, as the CEO is providing the information and has the authority to do so. Option C. Advise the CEO that trading on material non-public information is illegal under the Securities Exchange Act of 1934 and decline to discuss or act upon the information, while also refraining from executing any trades for the CEO based on this information. Option D. Inform other clients about the potential for a significant stock price increase, suggesting they consider purchasing shares of the CEO's company. The correct answer is C. Advise the CEO that trading on material non-public information is illegal under the Securities Exchange Act of 1934 and decline to discuss or act upon the information, while also refraining from executing any trades for the CEO based on this information. Explanation. This scenario presents a professional challenge because it requires a registered representative to navigate the complex interplay between client confidentiality, potential market manipulation concerns, and their duty to act in the client's best interest, all within the framework of the Securities Exchange Act of 1934. The representative must balance the client's desire for information with the regulatory obligations to prevent insider trading and maintain market integrity. Careful judgment is required to avoid both aiding and abetting potential violations and breaching client trust. The best professional approach involves a thorough understanding of the Securities Exchange Act of 1934, specifically its provisions against insider trading and manipulative practices. When a client inquires about non-public information that could significantly impact a securities price, the representative must decline to provide such information. Instead, they should educate the client on the legal and ethical implications of trading on material non-public information. This approach upholds the representative's duty to their client by protecting them from potential legal repercussions and ethical breaches, while simultaneously fulfilling their obligation to the market and regulatory bodies by refusing to facilitate or condone insider trading. This aligns with the spirit and letter of the Securities Exchange Act of 1934, which aims to ensure fair and orderly markets. An incorrect approach would be to provide the client with the non-public information, even if framed as a hypothetical or speculative discussion. This action directly violates Section 10(b) of the Securities Exchange Act of 1934 and Rule 10b-5, which prohibit the use of manipulative or deceptive devices in connection with the purchase or sale of securities. Providing such information, even indirectly, could be construed as aiding and abetting insider trading, exposing both the representative and the client to severe penalties. Another incorrect approach is to ignore the client's inquiry and proceed with executing trades based on the assumption that the information might be accurate. This demonstrates a lack of diligence and a failure to address the potential regulatory implications of the client's request. It also fails to protect the client from engaging in potentially illegal activity. A third incorrect approach is to report the client to regulatory authorities immediately without first attempting to understand the nature of the information or educating the client. While reporting suspicious activity is important, a more measured response that prioritizes client education and adherence to regulatory guidelines first is generally preferred, unless there is clear and immediate evidence of intent to violate the law. This approach could damage the client relationship unnecessarily and may not be the most effective way to prevent a violation. Professionals should adopt a decision-making framework that prioritizes understanding the regulatory landscape, assessing the nature of client inquiries, and acting with integrity. This involves proactive education of clients about securities laws, careful consideration of all information received, and a commitment to ethical conduct. When faced with a situation involving potential insider information, the professional should pause, analyze the information against the backdrop of the Securities Exchange Act of 1934, and choose the path that best upholds regulatory compliance and client protection. Question 3. Benchmark analysis indicates that a registered representative in California is preparing sales literature for a variable annuity. The literature highlights the potential for tax-deferred growth and a guaranteed death benefit, but it only briefly mentions that the contract's value can fluctuate with market performance and that surrender charges apply if funds are withdrawn early. The representative believes this literature is acceptable because it has been used successfully in the past, and the key features are present. Which of the following represents the most appropriate course of action regarding this sales literature? Option A. The sales literature must be reviewed by a qualified compliance professional to ensure all material risks, such as market fluctuation and surrender charges, are clearly and conspicuously disclosed in a balanced manner alongside the benefits, and that the claims are supported by the prospectus. Option B. Sales literature is acceptable because it mentions the potential for market fluctuations and surrender charges, even if briefly, and the representative has a history of successful sales with similar materials. Option C. The sales literature can be used as is, provided the representative verbally reminds clients about the potential for market fluctuations and surrender charges during their sales presentations. Option D. The sales literature should be approved if the representative adds a prominent disclaimer at the end, stating that all investments involve risk, and that past performance is not indicative of future results. The correct answer is A. The sales literature must be reviewed by a qualified compliance professional to ensure all material risks, such as market fluctuation and surrender charges, are clearly and conspicuously disclosed in a balanced manner alongside the benefits, and that the claims are supported by the prospectus. Explanation. This scenario presents a common challenge in financial services, ensuring that sales literature accurately reflects the risks and benefits of investment products, particularly variable contracts, without being misleading. The professional challenge lies in balancing promotional efforts with regulatory obligations to provide fair and balanced information. Misleading sales literature can lead to significant investor harm, regulatory sanction, and reputational damage. Careful judgment is required to interpret the nuances of disclosure and avoid even the appearance of impropriety. Best professional approach involves a thorough review of the sales literature by a qualified compliance professional. This individual should verify that all claims made in the literature are supported by the product's prospectus and other official documentation. Crucially, the compliance professional must ensure that the literature clearly and conspicuously discloses all material risks associated with the variable contract, such as market fluctuations, surrender charges, and the potential for loss of principal. This approach aligns with the principles of fair dealing and investor protection mandated by the Securities and Exchange Commission, SEC, and FINRA rules, which deem sales literature misleading if it omits material facts or makes unsubstantiated claims. An incorrect approach would be to approve the literature based solely on the sales team's assurance that it is effective and has been used in the past. This fails to acknowledge the regulatory requirement for independent compliance review and the potential for past practices to become non-compliant with evolving interpretations or specific product features. Another incorrect approach is to focus only on the positive performance aspects of the variable contract, while downplaying or omitting detailed explanations of the associated risks. This creates an unbalanced and potentially misleading impression, violating the spirit and letter of regulations requiring full and fair disclosure. Finally, relying on generic disclaimers that are not prominently displayed or adequately explained is also an unacceptable approach. Such disclaimers, if not integrated into the narrative and clearly linked to specific risks, can be easily overlooked by investors and do not fulfill the obligation to provide clear and understandable risk disclosures. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and investor protection. This involves a proactive approach to compliance, where sales and marketing materials are submitted for review well in advance of their intended use. The framework should include a clear understanding of what constitutes material information and misleading under SEC and FINRA rules. When in doubt, professionals should err on the side of caution and seek clarification from legal or compliance departments, or consult the product's prospectus and relevant regulatory guidance. The ultimate goal is to ensure that investors can make informed decisions based on complete and accurate information. Question 4. Risk assessment procedures indicate that a promising new client, an issuer of securities, is seeking to raise capital through a private placement in California. The issuer's representative assures you that they are well-connected and will handle all the paperwork, implying that the offering is exempt from registration under Regulation D. They also mention that they have conducted similar offerings in the past without any regulatory issues. Given this information, which approach best aligns with your professional and regulatory obligations? Option A. Rely on the issuer's statement that similar past offerings were not challenged by regulators, assuming this implies current compliance. Option B. Conduct thorough due diligence to independently verify that the offering meets all the specific requirements of a chosen Regulation D exemption, including the nature of purchasers and any restrictions on solicitation, and ensure the required Form D is filed. Option C. Proceed with the sale based on the issuer's assurance that they are well-connected and will manage the paperwork, assuming their expertise will ensure compliance. Option D. Accept the issuer's claim that it is a private placement and therefore exempt, without further investigation into the specific conditions of Regulation D. The correct answer is B. Conduct thorough due diligence to independently verify that the offering meets all the specific requirements of a chosen Regulation D exemption, including the nature of purchasers and any restrictions on solicitation, and ensure the required Form D is filed. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to balance the potential for significant business development with strict adherence to securities regulations. The pressure to close a deal, especially one involving a potentially lucrative private placement, can create an ethical conflict if it tempts the representative to overlook or misinterpret regulatory requirements. Careful judgment is required to ensure that all transactions comply with the Securities Act of 1933, specifically Regulation D, to protect both the client and the firm from legal and reputational damage. Correct approach analysis. The best professional practice involves meticulously verifying that the offering meets all the criteria for a Regulation D exemption before proceeding. This includes confirming the issuer's eligibility, the nature of the purchasers, accredited investors, or a limited number of sophisticated non-accredited investors, the limitations on general solicitation and advertising, and the filing of the appropriate Form D with the Securities and Exchange Commission, SEC, within the prescribed timeframe. This approach is correct because it prioritizes regulatory compliance, which is a fundamental ethical and legal obligation for all registered representatives. Adhering to these specific requirements ensures that the securities are offered and sold in a manner that the SEC deems sufficiently protected without the need for full registration, thereby avoiding violations of Section 5 of the Securities Act of 1933. Incorrect approach is analysis. Proceeding with the sale based solely on the issuer's assurance that they are well-connected and will handle the paperwork is professionally unacceptable. This approach fails to acknowledge the representative's own responsibility to ensure compliance. The issuer's assurances do not absolve the representative of the duty to verify the offering's status under Regulation D, particularly regarding the qualifications of purchasers and the prohibition of general solicitation. This could lead to an illegal unregistered offering. Accepting the issuer's claim that the offering is a private placement and therefore exempt without further investigation is also professionally unacceptable. While private placement is a common term, it is the specific conditions of Regulation D, such as Rule 506, that define the permissible scope of such offerings. Simply labeling it a private placement does not automatically grant an exemption. The representative must confirm that the specific conditions of the chosen Regulation D safe harbor are met, including purchaser sophistication and limitations on advertising. Relying on the fact that the issuer has previously conducted similar offerings that were not challenged by regulators is professionally unacceptable. Past regulatory inaction does not establish a precedent for future compliance or grant a blanket exemption. Each offering must be evaluated independently against current regulations. Furthermore, the representative has a duty to ensure compliance for the current transaction, regardless of historical events. Professional reasoning. Professionals should adopt a framework that prioritizes due diligence and regulatory adherence. When presented with an opportunity to participate in a private placement, The first step should always be to thoroughly understand the specific exemption being relied upon, e.g., Rule 506B or 506C under Regulation D. This involves independently verifying all the conditions of that exemption, including the issuer's representations, the nature and qualifications of potential investors, and any restrictions on solicitation. If any doubt or ambiguity exists, the representative should consult with their firm's compliance department or legal counsel before proceeding. The ultimate responsibility for ensuring compliance rests with the registered representative and their firm. Question 5. Operational review demonstrates that a mutual fund managed by your firm has achieved a top quartile ranking within its category for the past 3 years. In preparing a retail communication to highlight this achievement, what is the most appropriate method to ensure compliance with FINRA regulations in Ontario? Option A. Present the ranking prominently and include comprehensive disclosures regarding the ranking methodology, the universe of funds compared, the time period covered, and any associated fees or expenses. Option B. Feature the top quartile ranking as the primary message, with minimal disclosure of supporting details in a footnote. Option C. Use the ranking to suggest guaranteed future performance while providing a general disclaimer about investment risks. Option D. Emphasize the fund's strong performance based on the ranking, without mentioning the specific ranking source or its criteria. The correct answer is A. Present the ranking prominently and include comprehensive disclosures regarding the ranking methodology, the universe of funds compared, the time period covered, and any associated fees or expenses. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves balancing the desire to highlight a fund's strong performance with the regulatory obligation to present information fairly and without misleading investors. The use of rankings, while potentially attractive to retail investors, can be manipulated or presented in a way that overemphasizes past success without adequate context, potentially violating FINRA rules regarding fair dealing and the use of rankings in retail communications. Careful judgment is required to ensure that any communication is not only accurate but also not misleading. Correct approach analysis. The best professional practice involves presenting the ranking alongside crucial contextual information. This includes disclosing the universe of funds against which the ranking was made, the methodology used for the ranking, the time period covered by the ranking, and any fees or expenses associated with the fund. This approach is correct because it adheres to FINRA Rule 2211 and the NAST Rule 2210 as interpreted by FINRA guidance, which require that retail communications presenting rankings be fair, balanced, and not misleading. By providing comprehensive disclosure, the firm ensures that investors can make informed decisions based on a complete understanding of the ranking's significance and limitations. Incorrect approaches analysis. Presenting the ranking without any additional context or disclosure is professionally unacceptable. This approach fails to provide investors with the necessary information to understand the basis of the ranking, such as the size and composition of the universe of funds compared, the specific criteria used, or the time frame. This omission can lead investors to overestimate the fund's performance or draw inaccurate conclusions, violating the principles of fair dealing and potentially misleading investors under FINRA rules. Highlighting the ranking prominently while burying the disclosure information in small print or at the end of the communication is also professionally unacceptable. This tactic, while technically including some disclosure, is designed to obscure important details from the average retail investor. FINRA guidance emphasizes that disclosures must be clear, conspicuous, and easily understandable. Burying information undermines the intent of the disclosure requirements and can be considered a deceptive practice, failing to provide a fair and balanced presentation. Using a ranking from a less reputable or proprietary source without disclosing the source's methodology or potential biases is professionally unacceptable. While FINRA permits the use of rankings, it requires that they be presented in a manner that is not misleading. If the source of the ranking is not widely recognized or its methodology is not transparent, its use in a retail communication could be misleading. The firm has a responsibility to ensure that any third-party data used is reliable and presented with appropriate context, including the identity and methodology of the ranking provider, to avoid misleading investors. Professional reasoning. Professionals should approach the use of investment company rankings in retail communications with a strong emphasis on transparency and investor protection. The decision-making process should begin with a thorough understanding of FINRA rules and guidance concerning retail communications and the use of rankings. Before disseminating any communication, professionals should ask, is the ranking presented in a fair and balanced manner? Have all necessary disclosures been made clearly and conspicuously? Can an average retail investor understand the context and limitations of the ranking? If there is any doubt about the clarity or completeness of the information, the communication should be revised to ensure full compliance and ethical presentation. The ultimate goal is to empower investors with accurate and understandable information, not to impress them with selective data. Question 6. The performance metrics show a bond mutual fund's volatility rating, and a registered representative in Ontario, Canada, is considering how to present this information to a prospective client. Which of the following approaches best adheres to regulatory requirements and professional ethics? Option A. Use the volatility rating as a primary selling point to attract the client, without discussing its relationship to the client's personal financial situation or investment goals. Option B. Present the volatility rating as provided by a recognized rating agency, clearly explaining that it reflects historical price fluctuations and is not a guarantee of future performance, while also disclosing any relevant limitations of the rating and the fund's investment objectives. Option C. Provide the volatility rating without further explanation, assuming the client will understand its implications for risk and return. Option D. Highlight the volatility rating only when it suggests lower risk, and omit or downplay it when it indicates higher risk. The correct answer is B. Present the volatility rating as provided by a recognized rating agency, clearly explaining that it reflects historical price fluctuations and is not a guarantee of future performance, while also disclosing any relevant limitations of the rating and the fund's investment objectives. Explanation. The performance metrics show a bond mutual fund's volatility rating, and a registered representative is considering how to present this information to a prospective client in Ontario, Canada. This scenario is professionally challenging because it requires the representative to navigate the specific disclosure requirements for volatility ratings under Canadian securities regulations, particularly those enforced by the Ontario Securities Commission, OSC. Misrepresenting or inadequately disclosing this information can lead to investor confusion, misinformed investment decisions, and potential regulatory sanctions. Best professional approach involves accurately and clearly communicating the volatility rating alongside essential context. This means presenting the rating as provided by a recognized rating agency and ensuring the client understands that it is a measure of historical price fluctuations, not a guarantee of future performance or risk. Crucially, the representative must also disclose any limitations or specific methodologies used by the rating agency, as well as the fund's investment objectives and strategies, to provide a holistic view. This aligns with the OSC's mandate to protect investors and ensure fair and efficient capital markets by promoting transparency and informed decision-making. Presenting the volatility rating without explaining its meaning or limitations is professionally unacceptable. This failure to provide adequate context can mislead investors into believing the rating is a definitive measure of risk or a predictor of future returns, which is contrary to regulatory expectations for clear and comprehensive disclosure. Another professionally unacceptable approach is to selectively highlight the volatility rating only when it appears favorable, while omitting it or downplaying it when it suggests higher risk. This constitutes selective disclosure and is ethically problematic, as it prioritizes sales over the client's best interest and violates the principle of full and fair disclosure required by securities regulators. Finally, using the volatility rating as a primary selling point without relating it to the client's individual financial goals, risk tolerance, and investment horizon is also unacceptable. While volatility is a factor, it must be considered within the broader context of the client's personal financial situation and the fund's suitability. Failing to do so can lead to the recommendation of unsuitable investments, a direct contravention of regulatory obligations. Professionals should approach such situations by first understanding the specific regulatory requirements for presenting performance data and ratings in Ontario. They must then consider the client's individual circumstances and ensure that all information provided is accurate, complete, and presented in a manner that facilitates informed decision-making, always prioritizing the client's best interests. Question 7. Analysis of a situation in Ontario, Canada, where a registered firm is preparing to launch a new advertising campaign for a mutual fund. The marketing team has drafted several versions of the advertisement, each with a different emphasis. Which of the following approaches best adheres to the regulatory requirements and ethical obligations for financial advertising in Ontario? Option A. The advertisement focuses on the fund's low management expense ratio, implying that this alone guarantees superior net returns for investors. Option B. The advertisement clearly outlines the fund's investment objectives and strategies, prominently discloses the potential for investment loss, and includes a disclaimer that past performance is not indicative of future results. Option C. The advertisement heavily emphasizes the fund's strong historical returns over the past 5 years, using phrases like proven track record and exceptional growth potential. Option D. The advertisement uses exciting visuals and slogans designed to capture attention, with a brief mention of market fluctuations buried in the fine print. The correct answer is B. The advertisement clearly outlines the fund's investment objectives and strategies, prominently discloses the potential for investment loss, and includes a disclaimer that past performance is not indicative of future results. Explanation. This scenario presents a common ethical challenge in financial advertising, specifically concerning the promotion of investment products. The core difficulty lies in balancing the need to attract potential investors with the regulatory obligation to provide fair and balanced information, avoiding misleading statements or exaggerations. Professionals must exercise careful judgment to ensure that all advertising materials comply with the stringent rules governing financial promotions in Ontario, Canada, as overseen by the Ontario Securities Commission. OSC. The best approach involves prioritizing accuracy and completeness in all advertising materials. This means clearly stating both the potential benefits and the inherent risks associated with the investment product. Specifically, any advertisement must include a prominent disclosure of the investment's objectives, strategies, and the potential for loss of principal. This aligns directly with OSC's regulatory framework, which mandates that all advertising must be fair, balanced, and not misleading. By providing a comprehensive overview, the firm upholds its fiduciary duty to potential investors and adheres to the spirit and letter of securities law, preventing investors from making decisions based on incomplete or overly optimistic information. An approach that focuses solely on highlighting past performance without equally emphasizing future risks is ethically and regulatorily unsound. While past performance can be an indicator, it is not a guarantee of future results, and failing to disclose this crucial caveat can lead investors to form unrealistic expectations, potentially resulting in significant financial losses. This omission violates the OSC's requirement for fair and balanced advertising. Another unacceptable approach is to use vague or overly optimistic language that creates an impression of guaranteed returns or exceptional safety. Terms like sure thing or risk-free investment are inherently misleading and directly contraindicate the OSC's prohibition against deceptive advertising practices. Such language preys on investor psychology and fails to provide the objective information necessary for informed decision-making. Finally, an approach that omits essential details about the investment's fees, expenses, or liquidity constraints is also problematic. While not explicitly detailing every single fee might be permissible in some contexts, failing to disclose significant costs or limitations on accessing funds can materially impact an investor's net return and their ability to meet financial goals. This lack of transparency can be considered misleading under OSC guidelines, as it prevents a full understanding of the investment's true cost and accessibility. Professionals should adopt a decision-making framework that begins with a thorough understanding of the specific product being advertised and the relevant OSC regulations for advertising. Before any material is released, it should undergo a rigorous internal review process to ensure it is accurate, balanced, and free from misleading statements. This process should involve legal and compliance personnel to confirm adherence to all regulatory requirements and ethical standards. The guiding principle should always be to provide potential investors with sufficient, accurate information to make an informed decision, rather than to simply persuade them to invest. Question 8. The review process indicates that a registered representative in California, while discussing investment options with a long-term client who has expressed a desire for stable income and capital preservation, is also considering recommending a variable annuity. The client has mentioned concerns about market volatility impacting their retirement savings. The representative is aware that selling this particular variable annuity carries a significant commission. What is the most appropriate course of action for the representative? Option A. Emphasize the potential for tax-deferred growth and the death benefit rider of the variable annuity, downplaying the impact of surrender charges and market fluctuations to encourage the client to invest in the product to secure their retirement income. Option B. Recommend the variable annuity immediately due to its commission structure, advising the client that it is a superior product for generating stable income and preserving capital, without delving deeply into its complexities or potential downsides. Option C. Suggests that the client invest a substantial portion of their savings into the variable annuity, framing it as a limited-time opportunity to lock in favorable rates, thereby creating a sense of urgency to complete the transaction. Option D. Conduct a comprehensive suitability assessment, thoroughly explaining the variable annuity's features, risks, surrender charges, and tax implications, and compare it objectively with other suitable investment alternatives that align with the client's stated goals of income and capital preservation. The correct answer is D. Conduct a comprehensive suitability assessment, thoroughly explaining the variable annuity's features, risks, surrender charges, and tax implications, and compare it objectively with other suitable investment alternatives that align with the client's stated goals of income and capital preservation. Explanation. This scenario presents a professional challenge because it requires balancing a client's immediate financial needs with the fiduciary duty to act in their best interest, adhering to SEC rules and regulations. The representative must navigate potential conflicts of interest and ensure all recommendations are suitable and compliant, even when faced with pressure or a desire to close a sale. Careful judgment is required to avoid misrepresenting products or pushing unsuitable investments. The best professional approach involves a thorough suitability assessment that prioritizes the client's stated objectives, financial situation, and risk tolerance. This includes clearly explaining the features, risks, and costs of any recommended variable annuity, ensuring the client fully understands the product before making a decision. This approach aligns with SEC Rule 15C2-4, which governs the handling of proceeds from public offerings, and the broader principles of fair dealing and suitability, mandated by the Securities Exchange Act of 1934 and Investment Company Act of 1940. It upholds the fiduciary responsibility to place the client's interests above the representative's own. An approach that focuses solely on the potential commission without adequately assessing suitability or disclosing all relevant information is professionally unacceptable. This violates the SEC's anti-fraud provisions and the duty of care owed to the client. Failing to explain the surrender charges, tax implications, and the illiquid nature of the investment, while highlighting only the growth potential, constitutes a misrepresentation and omission of material facts. Another professionally unacceptable approach is to downplay the risks associated with the variable annuity or compare it unfavorably to lower-risk alternatives without a balanced discussion. This can mislead the client into believing the product is more secure or beneficial than it actually is, violating the principles of fair and balanced disclosure. Finally, an approach that pressures the client to make a decision quickly, citing limited-time offers or market timing, is also unacceptable. This creates an environment where the client may not have sufficient time for due diligence and could lead to a hasty, unsuitable decision, potentially violating SEC regulations against manipulative or deceptive practices. Professionals should employ a decision-making framework that begins with understanding the client's needs and objectives. This is followed by a comprehensive suitability analysis, a clear and transparent explanation of all product features, risks, and costs, and a thorough discussion of alternatives. Documentation of the entire process, including client conversations and suitability assessments, is crucial for demonstrating compliance and ethical conduct. Question 9. Performance analysis shows a new investment product has been launched in Ontario that claims to offer innovative features designed to attract a broader range of investors and facilitate capital formation. As a registered representative in Ontario, you are considering recommending this product to a client. Which of the following represents the most appropriate course of action, considering the mandate to promote efficiency, competition, and capital formation? Option A. Recommend the product based on its novelty and potential to attract new capital, without a detailed assessment of its impact on market efficiency or competition. Option B. Recommend the product primarily because it offers a higher commission rate for the representative, assuming it is a generally accepted investment. Option C. Recommend the product if it is suitable for the client's financial goals and risk tolerance, and if its features genuinely contribute to market efficiency and capital formation. Option D. Recommend the product if it is complex and innovative, even if the client may not fully understand its intricacies, as it is designed to attract new capital. The correct answer is C. Recommend the product if it is suitable for the client's financial goals and risk tolerance, and if its features genuinely contribute to market efficiency and capital formation. Explanation: this scenario is professionally challenging because it requires a registered representative to balance their duty to their client with the broader regulatory mandate to promote efficiency, competition, and capital formation within the Ontario securities market. The representative must avoid recommending products solely based on their own potential for higher commissions if those products are not demonstrably superior for the client's specific needs and do not contribute to market efficiency. Careful judgment is required to ensure that client recommendations align with both individual suitability and the public interest objectives outlined by the Ontario Securities Commission. OSC. The best approach involves a comprehensive evaluation of the investment product's alignment with the client's stated financial goals, risk tolerance, and time horizon, while also considering its potential to enhance market efficiency. This means assessing whether the product offers a genuine innovation, a more cost-effective solution, or a new avenue for capital deployment that benefits investors and the market as a whole. If the product meets these criteria and is suitable for the client, recommending it is appropriate. This aligns with the OSC's mandate under Ontario securities law to foster fair and efficient capital markets and to protect investors. The representative acts as a fiduciary, prioritizing the client's best interests while operating within the regulatory framework that encourages market development. Recommending an investment product solely because it offers a higher commission to the representative, without a thorough assessment of its suitability for the client or its contribution to market efficiency, is a regulatory failure. This prioritizes personal gain over client welfare and the public interest, potentially leading to unsuitable investments and undermining market integrity. Suggesting an investment product that is complex and difficult for the client to understand, even if it claims to promote capital formation, is also problematic. While complexity itself isn't prohibited, the representative has a duty to ensure the client comprehends the risks and benefits. If the product's complexity obscures its true nature or potential downsides, and the representative proceeds without adequate explanation and suitability assessment, it violates the principle of investor protection and can hinder genuine capital formation by leading to misallocated resources. Focusing exclusively on the product's novelty or its potential to attract new capital, without considering its suitability for the specific client or its actual impact on market efficiency and competition, is an incomplete approach. While innovation is encouraged, it must be balanced with investor protection and a realistic assessment of how the product contributes to a healthy, competitive market. A product that is novel but ultimately inefficient, or creates an unfair competitive advantage, would not serve the OSC's objectives. Professionals should adopt a decision-making framework that begins with a deep understanding of the client's individual circumstances and objectives. This must then be coupled with a thorough analysis of the investment product's characteristics, including its potential to enhance market efficiency, competition, and capital formation, as mandated by Ontario securities law. The representative must be able to articulate how the recommendation serves both the client's best interests and the broader regulatory goals. Transparency and a commitment to suitability are paramount. Question 10. The assessment process reveals that a registered representative in Ontario, Canada, is advising a client on whether to invest in a low-cost index mutual fund or a variable annuity with a guaranteed death benefit rider. The client is 50 years old, has a moderate risk tolerance, and is looking for long-term growth to supplement their retirement income. The mutual fund has an MER of 0, 75% and no sales charges. The variable annuity has underlying fund MERs totaling 1, 20%, an annual administrative fee of 0, 50%, and the guaranteed death benefit rider adds an additional 0, 75% annually. Assuming an average annual gross investment return of 7% for both products before fees and a 30-year investment horizon, What is the approximate difference in the net annual growth rate between the two products? Option A. The variable annuity's net annual growth rate is approximately 1.75% lower than the mutual funds. Option B. The variable annuity's net annual growth rate is approximately 2.50% lower than the mutual funds. Option C. The variable annuity's net annual growth rate is approximately 1.00% lower than the mutual funds. Option D. The variable annuity's net annual growth rate is approximately 0.50% lower than the mutual funds. The correct answer is A. The variable annuity's net annual growth rate is approximately 1.75% lower than the mutual funds. Explanation. The assessment process reveals a scenario where a registered representative must compare two investment products, a mutual fund and a variable annuity, to a potential client in Ontario, Canada. This is professionally challenging because the representative must not only understand the fundamental differences between these products, but also accurately convey their respective risks, benefits, and costs in a manner that is suitable for the client's financial situation and investment objectives, all while adhering to the regulatory requirements of the Ontario Securities Commission (OSC) and relevant industry standards. The complexity arises from the need for precise mathematical comparisons and the ethical obligation to provide unbiased, client-centric advice. The best professional approach involves a detailed quantitative comparison of the two products, focusing on the client's specific financial goals and risk tolerance. This includes calculating and explaining the total annual cost of each product, considering management fees, administrative fees, insurance charges for the variable annuity, and any surrender charges. For the mutual fund, the calculation would focus on the management expense ratio (MER) and any applicable sales charges. For the variable annuity, it would involve summing the underlying fund MERs, the annuity's administrative fees, and the cost of any riders or guarantees. The representative should then project potential returns for both scenarios, clearly stating the assumptions used, e.g., growth rates, and illustrating the impact of these costs and potential returns on the client's net investment growth over a specified period. This approach is correct because it directly addresses the client's need for clear, quantifiable information to make an informed decision, aligning with the OSC's principles of suitability and fair dealing. It provides a transparent and objective basis for comparison, enabling the client to understand the trade-offs involved. An incorrect approach would be to focus solely on the potential for higher growth in the variable annuity, without adequately disclosing or quantifying the associated higher costs and risks, such as the impact of market downturns on the guaranteed death benefit or the complexity of the fee structure. This fails to meet the regulatory requirement for full disclosure and suitability, potentially misleading the client into believing the variable annuity is a superior investment without understanding the full financial implications. Another incorrect approach would be to present a qualitative comparison, highlighting general features like tax deferral for the annuity versus potential tax efficiency for the mutual fund, without providing concrete numerical examples of costs and projected net returns. This lacks the specificity required for a client to make a truly informed decision and may not satisfy the duty of care owed to the client under Ontario securities law. A further incorrect approach would be to emphasize the guaranteed features of the variable annuity without clearly explaining the trade-off in terms of significantly higher fees and potentially lower net returns compared to a comparable mutual fund, especially if the client has a long investment horizon and a moderate risk tolerance. This selective presentation of information can lead to a biased recommendation. Professionals should adopt a decision-making process that prioritizes client needs and regulatory compliance. This involves 1. Thoroughly understanding the client's financial situation, objectives, and risk tolerance. 2. Conducting a detailed quantitative analysis of all relevant products, including all fees, charges, and potential returns under various market scenarios. 3. Presenting the information clearly and concisely, using plain language and visual aids where appropriate, ensuring all material facts and risks are disclosed. 4. Allowing the client ample opportunity to ask questions and providing objective, unbiased answers. 5. Documenting the entire process, including the client's objectives, the analysis performed, and the rationale for any recommendation. Question 11. In the state of California, a registered representative is meeting with a prospective client to discuss investment opportunities. The representative is eager to meet their quarterly sales targets. Which of the following approaches best reflects the intent of soliciting business in compliance with FINRA regulations? Option A, emphasizing how a specific variable annuity's high commission payout allows the representative to offer more personalized service and ongoing support to the client. Option B, clearly explaining the features, risks, and potential benefits of various investment products, while actively inquiring about the prospective client's financial situation, investment objectives, and risk tolerance to determine suitability. Option C, assuring the prospective client that a particular bond offering is a safe bet and will provide a guaranteed return despite the issuer's recent credit rating downgrade. Option D, highlighting only the potential for significant capital appreciation of a particular mutual fund, while downplaying the inherent market volatility and potential for loss. The correct answer is B, clearly explaining the features, risks, and potential benefits of various investment products, while actively inquiring about the prospective client's financial situation, investment objectives, and risk tolerance to determine suitability. Explanation: this scenario is professionally challenging because it requires a registered representative to balance the need to generate business with the absolute requirement to avoid misleading prospective clients. The intent behind soliciting business must always be to provide suitable investment opportunities based on a client's genuine needs and financial situation, not to pressure them into products that may not be appropriate. Misrepresenting the nature or benefits of an investment product, even with the perceived intent of making a sale, violates fundamental ethical and regulatory principles designed to protect investors. The best approach involves clearly and accurately communicating the features, risks, and benefits of investment products, and actively seeking to understand the prospective client's financial goals, risk tolerance, and investment experience. This aligns with the spirit and letter of FINRA regulations, specifically those concerning fair dealing with customers and the prohibition of misrepresentation. By focusing on a client's suitability and providing transparent information, the representative fulfills their fiduciary duty and builds trust, which is the foundation of a sustainable business. This approach ensures that any business generated is a natural outcome of a client's informed decision, rather than a result of undue influence or deception. An approach that emphasizes the potential for high returns without adequately disclosing the associated risks is ethically and regulatorily unsound. This misrepresents the investment and fails to meet the requirement for fair dealing. Similarly, focusing solely on the commission structure of a product, even if framed as a benefit to the client, e.g., "This product pays me well so I can dedicate more time to you," is a form of self-dealing and can create a conflict of interest. It shifts the focus from the client's best interest to the representative's financial gain. Finally, suggesting that an investment is guaranteed or risk-free when it is not, regardless of the representative's intent to close a sale, is a direct violation of anti-fraud provisions and the duty to provide accurate information. Professionals should employ a decision-making framework that prioritizes client suitability and transparency above all else. This involves actively listening to a client's needs, thoroughly researching and understanding the products being recommended, and communicating all material information, both positive and negative, in a clear and understandable manner. When in doubt about the appropriateness of a product or the clarity of communication, seeking guidance from a supervisor or compliance department is a critical step in maintaining ethical and regulatory compliance. The intent to solicit business should always be secondary to the intent to serve the client's best interests. Question 12. Comparative studies suggest that effective client communication is paramount in the financial services industry. In Ontario, Canada, when a registered representative is discussing a new investment fund with a prospective client, and the fund is in its preliminary offering stage, what is the most compliant and ethically sound approach regarding the delivery of the prospectus? Option A. Wait for the client to explicitly request the prospectus before providing it. Option B. Provide the client with the final prospectus only after they have indicated their intention to invest, but before the transaction is finalized. Option C. Provide the client with the preliminary prospectus at the earliest opportunity during the initial discussion, before accepting any order, and ensure the final prospectus is delivered before the transaction is completed. Option D. Provide the client with a link to the fund's prospectus on the issuer's website and assume they will access and review it. The correct answer is C. Provide the client with the preliminary prospectus at the earliest opportunity during the initial discussion, before accepting any order, and ensure the final prospectus is delivered before the transaction is completed. Explanation. Scenario analysis. This scenario presents a common challenge for registered representatives in Ontario, Canada, when dealing with investment fund prospectuses. The core difficulty lies in balancing the need to provide clients with timely and accurate information against the regulatory requirements for prospectus delivery. Misinterpreting or neglecting these requirements can lead to regulatory sanctions, client dissatisfaction, and potential legal liabilities. The representative must navigate the specific timing mandates set forth by the Ontario Securities Commission (OSC) to ensure compliance. Correct approach analysis. The best professional practice involves providing the client with the preliminary prospectus, also known as the red herring, at the earliest possible stage of the sales process, specifically when the representative first discusses the investment fund with the client and before any order is accepted. This approach aligns with the OSC's mandate to ensure investors receive adequate disclosure to make informed decisions. The preliminary prospectus contains essential information about the fund's investment objectives, strategies, risks, fees, and management, even though it is subject to change. Providing it early allows the client ample time to review the document and ask questions before committing to an investment. This proactive disclosure is ethically sound and legally compliant with Ontario securities law. Incorrect approach is analysis. Providing the final prospectus only after the client has agreed to invest, but before the transaction is completed, fails to meet the spirit and letter of the law. While the final prospectus is the definitive document, delaying its delivery until after the client has expressed intent to purchase deprives them of the opportunity to review all material information and risks prior to making a commitment. This could be seen as a violation of the duty to provide full, true, and plain disclosure. Another incorrect approach is to only provide the prospectus upon client request, as the onus is on the registrant to ensure the client receives it in a timely manner, not to wait for a request that may never come. This neglects the proactive disclosure obligation. Finally, relying solely on a website link without ensuring the client has actually accessed and reviewed the prospectus is insufficient. While websites are a common delivery method, the representative must take reasonable steps to confirm the client has received and understood the information, especially for a preliminary document that is crucial for initial decision-making. Professional reasoning. Professionals in Ontario should adopt a systematic approach to prospectus delivery. This involves understanding the specific requirements for preliminary and final prospectuses under Ontario securities law. The decision-making process should prioritize client protection and informed consent. When engaging with a potential investor, the representative should immediately identify the need for prospectus disclosure. The preliminary prospectus should be offered and delivered at the first substantive discussion about the investment. If the client expresses interest, the representative should then ensure the final prospectus is delivered and reviewed before the transaction is finalized, confirming the client's understanding of any changes from the preliminary version. This layered approach ensures compliance and fosters trust. Question 13. The investigation demonstrates that a registered representative in Ontario, Canada, is seeking to expand their client base by contacting individuals who have not previously engaged with their services. What is the most compliant and professionally sound method for initiating contact with these potential clients? Option A. Send unsolicited marketing brochures detailing a range of investment products without any prior personal interaction. Option B. Introduce themselves and their firm, briefly state the purpose of the contact, e.g., to explore potential investment needs, and ask for permission to provide more information or schedule a follow-up conversation. Option C. Immediately inquire about the prospect's current investment portfolio and risk tolerance to determine suitability for specific products. Option D. Ask if the prospect is interested in making a quick profit on a specific high-return investment opportunity. The correct answer is B. Introduce themselves and their firm, briefly state the purpose of the contact, e.g., to explore potential investment needs, and ask for permission to provide more information or schedule a follow-up conversation. Explanation. The investigation demonstrates a common challenge faced by registered representatives in Ontario, Canada, when initiating contact with potential clients. The core difficulty lies in balancing proactive business development with the strict requirements of the Ontario Securities Commission, OSC, regulations regarding unsolicited contact, and the need to establish a professional and compliant relationship from the outset. A representative must navigate the fine line between introducing their services and potentially soliciting business, without having a pre-existing relationship or a clear understanding of the prospect's investment objectives and risk tolerance. The best approach involves a carefully worded initial communication that clearly identifies the representative and their firm, states the general purpose of the contact, e.g., to introduce services or explore potential needs, and crucially, seeks the prospect's consent to further discussion or to provide information. This method respects the prospect's time and privacy, adheres to the OSC's emphasis on suitability and client understanding, and sets a professional tone. It allows the prospect to control the interaction and decide if and when they wish to engage further, thereby avoiding any perception of undue pressure or unsolicited solicitation that could violate regulatory expectations. An approach that immediately delves into specific investment products or asks detailed questions about the prospect's financial situation without prior consent is problematic. This can be perceived as aggressive solicitation and may violate the spirit, if not the letter, of regulations that require a foundation of suitability before offering advice or products. Furthermore, failing to clearly identify oneself and the firm at the outset can lead to confusion and a lack of trust, which is detrimental to building a compliant and professional client relationship. Another less effective approach is to send generic marketing materials without any prior personal contact or an opportunity for the prospect to opt in. While not explicitly prohibited in all contexts, it lacks the personalized touch required for effective client engagement and may not adequately address the prospect's specific needs or interests, potentially leading to low engagement and a missed opportunity to establish a compliant dialogue. Professionals should adopt a decision-making process that prioritizes transparency, respect for the prospect's autonomy, and strict adherence to regulatory guidelines. This involves understanding the purpose of the initial contact, clearly identifying oneself and the firm, stating the general intent of the communication, and always seeking consent before proceeding with more detailed discussions or information sharing. This proactive compliance ensures that all interactions are professional, ethical, and in line with OSC expectations for client engagement. Question 14. Assessment of a registered representative's actions in New York when they discover a factual error in a prospectus for a new mutual fund offering that has already been filed with the SEC and distributed to potential investors, and the representative is scheduled to present this fund to clients tomorrow. Which of the following courses of action best adheres to regulatory requirements and professional ethics? Option A. Proceed with the client presentation as planned, assuming the error is minor and unlikely to affect investor decisions. Option B. Immediately report the discovered discrepancy to the firm's compliance department and legal counsel for investigation and guidance. Option C. Attempt to correct the prospectus information independently by creating a supplementary document for clients before the presentation. Option D. Inform clients directly about the error during the presentation and explain the potential implications without consulting the firm first. The correct answer is B. Immediately report the discovered discrepancy to the firm's compliance department and legal counsel for investigation and guidance. Explanation. Scenario analysis. This scenario presents a professional challenge because it involves a potential misstatement in a prospectus, which carries significant civil liability under the Securities Act of 1933 in the United States. A registered representative has a duty to ensure that communications with clients are accurate and not misleading, especially when they relate to investment offerings. Failure to do so can result in substantial financial penalties and reputational damage. The representative must navigate the complexities of Section 12 liabilities, which can arise from misstatements or omissions in prospectuses and other communications. Correct approach analysis. The best professional practice involves promptly reporting the discovered discrepancy to the appropriate internal compliance department and the firm's legal counsel. This approach is correct because Section 12(a)(2) of the Securities Act of 1933 imposes liability on sellers of securities who offer or sell them by means of a prospectus or oral communication that includes an untrue statement of a material fact or omits to state a material fact necessary to make the statements made, in light of the circumstances under which they were made, not misleading. by immediately escalating the issue internally. The representative initiates the firm's established procedures for investigating and rectifying potential prospectus deficiencies, thereby mitigating the firm's and their own potential liability. This proactive step aligns with the ethical obligation to act in the best interest of the client and to uphold the integrity of the securities markets. Incorrect approaches analysis. One incorrect approach involves ignoring the discrepancy and proceeding with client communications as if no issue exists. This is a significant regulatory and ethical failure. It directly violates the representative's duty to ensure accuracy in communications and exposes both the representative and the firm to liability under Section 12(a). 2. For offering securities via a misleading prospectus. This inaction demonstrates a disregard for the material nature of the information and the potential harm to investors. Another incorrect approach is to attempt to correct the prospectus information independently without consulting the firm's compliance or legal departments. This is professionally unacceptable because it bypasses the established internal controls designed to manage regulatory compliance and legal risk. The representative may not have the full picture of the discrepancy's implications or the authority to make binding corrections. This could lead to further misstatements or an incomplete correction, still exposing the representative and the firm to liability. A third incorrect approach is to disclose the discrepancy directly to clients without first informing the firm's compliance department. While transparency is important, this method circumvents the firm's legal and compliance oversight. The firm needs to manage the disclosure process to ensure accuracy, consistency, and adherence to regulatory requirements. Unauthorized disclosure could create further complications and potential liability for the firm. Professional reasoning. Professionals facing such a situation should follow a clear decision-making framework. First, recognize the potential materiality of the discrepancy and the associated regulatory implications. Second, understand the firm's internal policies and procedures for handling compliance issues and potential prospectus deficiencies. Third, prioritize immediate communication with the firm's compliance department and legal counsel. This ensures that the issue is addressed through the proper channels, with appropriate expertise, and in a manner that minimizes legal and ethical risks for all parties involved. Question 15. The monitoring system demonstrates that a registered representative in California has drafted a social media post intended for broad public dissemination. The post aims to increase awareness of the firm's retirement planning services and encourage individuals to consider their long-term financial security. The representative is seeking to understand the most appropriate way to frame this communication to comply with regulations governing investment company and variable contract products. Option A. Share a client testimonial about their positive experience with the firm's retirement planning services. Option B. Create a post that highlights the firm's new variable annuity product and its potential for tax-deferred growth. Option C. Create a post that discusses the general importance of saving for retirement and the benefits of long-term financial planning, without mentioning any specific investment products or making performance projections. Option D. Create a post that discusses current market conditions and suggests that investors should consider diversifying their portfolios, without any mention of the firm or its services. The correct answer is C. Create a post that discusses the general importance of saving for retirement and the benefits of long-term financial planning, without mentioning any specific investment products or making performance projections. Explanation. This scenario presents a professional challenge because it requires a registered representative to balance the desire to promote their firm's services with the strict regulatory requirements governing generic advertising. The representative must exercise careful judgment to ensure that any communication, even if seemingly innocuous, adheres to FINRA rules regarding investment company and variable contract products. The core of the challenge lies in distinguishing between permissible general information and impermissible misleading or unbalanced portrayals. The best professional approach involves creating a social media post that highlights the firm's commitment to financial education and provides a general overview of the benefits of retirement planning, without mentioning specific products or making performance claims. This approach is correct because it aligns with FINRA Rule 2211, Communications with the Public, and the guidelines for generic advertising. Such communications are permitted to discuss the general benefits of investing or saving for retirement, provided they do not promote specific securities or investment strategies. By focusing on education and general concepts, the representative avoids making any representations that could be construed as misleading or requiring specific product disclosures, thus satisfying the requirements for generic advertising. An incorrect approach would be to create a social media post that mentions the firm's new variable annuity product and highlights its potential for tax-deferred growth. This is professionally unacceptable because it moves beyond generic advertising by referencing a specific product. FINRA rules require that communications mentioning specific investment products must be fair, balanced, and include all necessary disclosures, which is not feasible or intended in a generic advertisement. Another incorrect approach would be to share a client testimonial about their positive experience with the firm's retirement planning services, even if it doesn't mention specific products. This is professionally unacceptable because testimonials, even if seemingly positive in general, can be considered an endorsement and may imply that all clients will achieve similar results, which is misleading and violates the principles of fair representation in advertising. Finally, an incorrect approach would be to create a social media post that discusses the current market conditions and suggests that investors should consider diversifying their portfolios without any mention of the firm or its services. While this might seem harmless, it fails to meet the purpose of a firm's communication, which is to promote its services. More importantly, without a clear disclaimer or context linking it to the firm's offerings, it could be seen as providing investment advice without proper registration or disclosures, and it doesn't serve the firm's advertising goals. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves understanding the specific rules governing communications with the public, particularly for generic advertising. Before disseminating any communication, a professional should ask, does this communication promote a specific product or service? Does it make any performance claims? Is it fair and balanced? Does it include all necessary disclosures? If the answer to any of these questions raises concerns, the communication should be revised or not disseminated. Consulting with the firm's compliance department is always a prudent step when in doubt. Question 16. Regulatory review indicates that a registered representative in California has been approached by an issuer seeking to offer a new mutual fund to the public. The issuer has provided marketing materials and expressed an urgent desire to begin soliciting investments. What is the most appropriate course of action for the representative to ensure compliance with federal and California securities regulations? Option A. Rely on the issuer's verbal assurance that the securities are exempt from registration and begin marketing the product. Option B. Proceed with soliciting investments immediately upon receiving the issuer's marketing materials, assuming the issuer is acting in good faith. Option C. Distribute the final prospectus to potential investors as soon as it is provided by the issuer, regardless of the registration statement's effective date. Option D. Verify that a registration statement has been filed with the Securities and Exchange Commission and that a preliminary prospectus is available for distribution to potential investors, while also confirming compliance with California's registration requirements. The correct answer is D. Verify that a registration statement has been filed with the Securities and Exchange Commission and that a preliminary prospectus is available for distribution to potential investors, while also confirming compliance with California's registration requirements. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a registered representative to navigate the complex regulatory landscape of bringing a new investment product to market in California. The representative must balance the issuer's desire for a swift launch with the stringent requirements of the Securities Act of 1933 and California state securities laws, particularly concerning the registration process and the prohibition of selling unregistered securities. Failure to adhere to these regulations can lead to severe penalties for both the firm and the individual, including fines, sanctions, and reputational damage. Correct approach analysis. The correct approach involves diligently following the established process for bringing new issues to market, which begins with thorough due diligence and culminates in the filing and effectiveness of a registration statement with the Securities and Exchange Commission, SEC, and compliance with California's registration requirements. This includes ensuring that a preliminary prospectus, often referred to as a red herring, is available to potential investors once the registration statement is filed and before it is declared effective. This approach is correct because it directly aligns with the mandates of the Securities Act of 1933, which requires registration of securities offered to the public, and the anti-fraud provisions that necessitate providing investors with material information through a prospectus. California's Corporate Securities Law of 1968 also requires registration or an exemption for securities sold within the state. By waiting for the registration statement to be filed and a preliminary prospectus to be available, the representative ensures compliance with federal and state securities laws, protecting both investors and themselves from regulatory violations. Incorrect approaches analysis. An approach that involves proceeding with sales immediately upon receiving the issuer's marketing materials, without verifying registration status or the availability of a preliminary prospectus, constitutes a serious regulatory failure. It bypasses the fundamental requirement of the Securities Act of 1933 to register securities and provide investors with adequate disclosure. It also violates California's corporate securities law by potentially offering unregistered securities. Another incorrect approach is to rely solely on the issuer's assurance that the securities are exempt, without independently verifying the validity of such exemption under federal and state law. This demonstrates a lack of due diligence and a failure to uphold the representative's responsibility to ensure compliance. Finally, an approach that involves distributing a final prospectus before the SEC has declared the registration statement effective is also problematic, as it misrepresents the status of the offering and may mislead investors about the final terms and conditions of the security. Professional reasoning. Professionals should approach new issue offerings with a systematic process. This begins with understanding the issuer's product and business, conducting thorough due diligence to assess the risks and merits of the offering, and confirming that the securities are properly registered or exempt from registration at both the federal and state levels. For offerings requiring registration, the representative must ensure that a registration statement has been filed with the SEC and that a preliminary prospectus is available for distribution to prospective investors. They must also confirm compliance with any state-specific registration or notice filing requirements, such as those in California. A commitment to transparency and adherence to regulatory timelines is paramount to ethical conduct and legal compliance. Question 17. Consider a scenario in California where a registered representative is preparing to distribute preliminary information about an upcoming private placement offering of a new technology company. The company has not yet filed a registration statement with the U.S. Securities and Exchange Commission. The representative wants to send out a document that highlights the company's innovative technology, its market potential, and the anticipated benefits for investors, but does not explicitly state a price or terms of sale. Which of the following approaches best ensures compliance with the Securities Act of 1933 regarding materials not deemed an offer to sell or a prospectus? Option A. Distribute the document, which includes detailed financial projections and a strong indication of the company's intent to raise capital soon, as it does not mention a specific price. Option B. Distribute the document, which includes a call to action encouraging interested parties to contact the representative immediately to express their interest in purchasing shares. Option C. Distribute the document, which names the specific technology company and describes its innovative product, implying that shares will be available for purchase in the near future. Option D. Distribute the document, ensuring it clearly states that it is not an offer to sell or buy any securities, that no offer to buy or sell can be accepted until a registration statement is filed, and that prospectus will be made available at that time. The correct answer is D. Distribute the document, ensuring it clearly states that it is not an offer to sell or buy any securities, that no offer to buy or sell can be accepted until a registration statement is filed, and that prospectus will be made available at that time. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a nuanced understanding of what constitutes an offer to sell versus permissible sales literature under the Securities Act of 1933, specifically Section 2(a)(3) and Rule 135(b). Mischaracterizing sales material as something other than an offer can lead to violations, potentially subjecting the firm and individuals to regulatory scrutiny and penalties. The core difficulty lies in distinguishing between information that merely solicits interest and information that crosses the line into a formal offer, especially in the context of unregistered securities or when a prospectus is not yet available. Correct approach analysis. The best professional practice is to ensure that any communication, even if intended as preliminary information, does not contain elements that would cause it to be deemed an offer to sell or a prospectus under the Securities Act of 1933. This involves carefully reviewing the content to confirm it does not specify a security, its price, or the terms of sale, and that it clearly indicates that no offer to buy or sell can be accepted until a registration statement is filed and a prospectus is available. This approach aligns with Rule 135B, which provides safe harbor provisions for certain communications that might otherwise be construed as offers, by ensuring they do not contain the essential elements of an offer. Incorrect approaches analysis. One incorrect approach would be to distribute a document that, while not explicitly stating a price, includes detailed projections and performance data that, when combined with a clear indication of the issuer's intent to sell, could be interpreted by a reasonable investor as an offer. This fails to adhere to the spirit and letter of the Securities Act by providing information that, in context, effectively solicits an investment decision before the registration process is complete. Another incorrect approach would be to send out a pre-filing communication that names the specific security and implies its availability for purchase, even without a stated price. This directly contravenes the requirement that such communications do not specify a security for which a registration statement has been filed or is about to be filed, and thus could be considered an offer. A third incorrect approach would be to distribute a document that, while not a formal prospectus, contains language that strongly encourages immediate investment and provides contact information for placing orders, without the necessary disclaimers about the pending registration and prospectus availability. This type of communication goes beyond mere solicitation of interest and can be construed as an attempt to secure commitments to buy before the offering is legally permissible. Professional reasoning. Professionals must adopt a conservative approach when disseminating information about securities that are in the registration process. The decision-making framework should involve a thorough review of all communications against the definitions of offer to sell and prospectus in the Securities Act of 1933. If there is any ambiguity, it is prudent to err on the side of caution, ensuring that the communication clearly states that it is not an offer and that no purchase or sale can occur until a registration statement is filed and a statutory prospectus is delivered. Consulting with legal counsel is advisable when in doubt. Question 18. Upon reviewing a client's investment portfolio in California, a registered representative discovers that the client is proposing to sell a significant block of unregistered securities to a group of individuals in Nevada through a series of private placements, with the stated intention of avoiding the disclosure requirements associated with a public offering. The representative suspects this structure may be designed to mislead potential investors about the true nature and risks of the securities. What is the most appropriate course of action for the representative? Option A. Refuse to facilitate the transaction and explain to the client that the proposed structure may violate federal laws prohibiting fraudulent interstate transactions. Option B. Report the client's request to the firm's compliance department. If compliance does not issue a definitive prohibition, proceed with assisting the client in executing the transaction. Option C. Advise the client on how to modify the private placement structure to make it appear compliant with regulations, while still achieving the client's objective of avoiding public disclosure. Option D. Proceed with the transaction as requested by the client, as the client is directing the sale and the representative is merely an intermediary. Correct answer is A. Refuse to facilitate the transaction and explain to the client that the proposed structure may violate federal laws prohibiting fraudulent interstate transactions. Explanation. This scenario presents a professional challenge because it requires a representative to navigate a situation where a client's request, while seemingly beneficial to the client in the short term, carries significant legal and ethical risks under federal securities law, specifically Section 17 of the Securities Act of 1933, which prohibits fraudulent interstate transactions. The representative must balance their duty to the client with their obligation to uphold the law and protect the integrity of the securities markets. Misinterpreting or ignoring the potential for fraud could lead to severe penalties for both the representative and the client. The best professional approach involves recognizing the inherent risks in the client's proposed transaction and refusing to facilitate it. This approach is correct because Section 17 of the Securities Act of 1933 broadly prohibits the use of any device, scheme, or artifice to defraud, or any transaction, practice, or course of business which operates or would operate as a fraud or deceit upon the purchaser in the offer or sale of any security in interstate commerce. By suggesting a transaction that appears designed to circumvent disclosure requirements and potentially mislead investors, the client's request falls squarely within the purview of fraudulent interstate transactions. A representative's ethical and legal duty is to refuse to participate in or facilitate such activities, even if it means disappointing a client. This upholds the principles of investor protection and market integrity. An incorrect approach involves proceeding with the transaction as requested by the client. This is professionally unacceptable because it directly violates Section 17 of the Securities Act of 1933 by participating in a transaction that is likely to operate as a fraud or deceit. It demonstrates a failure to understand or a willful disregard for federal securities laws, exposing both the representative and the client to significant legal repercussions, including civil and criminal penalties. Another incorrect approach involves advising the client on how to structure the transaction to appear legitimate, while still achieving the same potentially deceptive outcome. This is also professionally unacceptable. It constitutes aiding and abetting fraudulent activity and demonstrates a severe ethical lapse. The representative's role is not to find loopholes to facilitate potentially fraudulent schemes, but to ensure compliance with all applicable laws and regulations. A final incorrect approach involves reporting the client's request to the firm's compliance department, but then proceeding with the transaction if compliance does not explicitly forbid it. While reporting to compliance is a positive step, it does not absolve the representative of their personal responsibility to ensure the transaction is lawful. If the representative has reason to believe the transaction is fraudulent, they should not proceed even if compliance offers a less than definitive response. The ultimate responsibility for adhering to Section 17 rests with the individual representative. The professional reasoning process for such situations should involve a clear understanding of federal securities laws, particularly those related to fraud. When faced with a client request that raises red flags, the representative should first identify the specific legal and ethical concerns. They should then consult relevant regulations and firm policies. If the request appears to violate these, the representative must refuse to participate and clearly explain the legal and ethical reasons for their refusal to the client. If there is any doubt, seeking guidance from the firm's compliance department or legal counsel is crucial, but the representative must ultimately make a decision that prioritizes legal compliance and ethical conduct. Question 19. When evaluating a potential sale of a new issue in California, a registered representative learns that the client is eager to invest but has not yet received the final prospectus. The representative has a copy of the preliminary prospectus and has verbally summarized the key features of the offering. The client states they trust the representative and don't need to read the prospectus. What is the most appropriate course of action? Option A. Accept the client's assurance that they don't need to read it and process the order, relying on the selling group agreement to cover prospectus delivery obligations. Option B. Provide the client with the preliminary prospectus and proceed with the sale, as it contains sufficient information for an initial understanding. Option C. Proceed with the sale based on the verbal summary and the client's trust, as they have indicated they don't need to read the prospectus. Option D. Confirm the client has received the final prospectus and offer to discuss its contents before accepting the order. The correct answer is D. Confirm the client has received the final prospectus and offer to discuss its contents before accepting the order. Explanation. Scenario analysis. This scenario presents a professional challenge because a registered representative is faced with conflicting pressures: the desire to facilitate a sale and earn a commission, and the absolute regulatory requirement to ensure a client fully understands the risks and terms of an investment, particularly when dealing with a new offering. The representative must navigate the complexities of the prospectus and the selling group agreement while upholding their fiduciary duty to the client. This requires careful judgment to prioritize regulatory compliance and client best interests over potential personal gain or expediency. Correct approach analysis. The The best professional practice involves proactively ensuring the client has received and had an opportunity to review the final prospectus before accepting any order. This approach directly aligns with the Securities Act of 1933, which mandates that a prospectus must be delivered to purchasers of securities. By confirming receipt and offering to discuss the prospectus, the representative demonstrates a commitment to regulatory compliance and client education. This fulfills the obligation to provide material information, allowing the client to make an informed investment decision, and adheres to the spirit of the underwriting and selling group agreements, which are predicated on the lawful and transparent distribution of securities. Incorrect approach is analysis, proceeding with the sale after a brief verbal summary of the offering, without confirming the client has received and reviewed the final prospectus, is a significant regulatory failure. This bypasses the core purpose of the prospectus, which is to provide detailed, legally mandated disclosures. It violates the Securities Act of 1933 and potentially the rules of FINRA regarding fair dealing and suitability. Ethically, it prioritizes the sale over the client's right to informed consent. Accepting the client's assurance that they don't need to read it and proceeding with the sale without further action is also professionally unacceptable. While the client may express disinterest, the representative's obligation to ensure delivery and provide an opportunity for review remains. This approach ignores the legal requirement for prospectus delivery and the representative's duty to act in the client's best interest, potentially leading to misrepresentation or omission of material facts. Relying solely on the selling group agreement to absolve the representative of responsibility for prospectus delivery is a misunderstanding of their role. While the selling group agreement outlines the terms of distribution, it does not supersede the fundamental legal requirement for prospectus delivery to the ultimate purchaser. The representative remains accountable for ensuring compliance with securities laws, including those pertaining to prospectus delivery, regardless of the agreements between intermediaries. This constitutes a failure to adhere to the Securities Act of 1933 and FINRA regulations. Professional reasoning. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client best interests. This involves 1. Understanding the specific legal requirements for offering new securities, including prospectus delivery mandates under the Securities Act of 1933. 2. Recognizing the role and limitations of agreements like the underwriting and selling group agreements. 3. Actively verifying that all regulatory prerequisites, such as prospectus delivery, have been met before accepting client orders. 4. Proactively offering to explain complex information and answer client questions regarding the prospectus. 5. Documenting all interactions and confirmations related to prospectus delivery and client understanding. Question 20. The analysis reveals that a California-based technology startup is planning a private placement offering under Regulation D. The offering will not involve general solicitation or advertising. The company has identified 100 potential investors. Of these, 70 are confirmed accredited investors. The remaining 30 potential investors are not accredited. The company has assessed that 25 of these non-accredited investors possess significant financial acumen and experience, capable of evaluating the investment's merits and risks without a purchaser representative. The remaining 5 non-accredited investors, while having the financial means, would require a purchaser representative to adequately assess the investment. If the offering proceeds with all 100 identified investors participating as purchasers, what is the maximum number of non-accredited investors that can participate in this offering under Rule 506(b) of Regulation D to maintain the exemption from registration under the Securities Act of 1933? Option A. 30 non-accredited investors, provided that 25 meet the sophistication requirements and the remaining 5 utilize a purchaser representative. Option B. 35 non-accredited investors, regardless of their sophistication or the use of a purchaser representative. Option C. 25 non-accredited investors, as only those with demonstrated sophistication can participate. Option D. 100 investors in total, as the offering is private and does not involve general solicitation. The correct answer is A. 30 non-accredited investors, provided that 25 meet the sophistication requirements and the remaining 5 utilize a purchaser representative. Explanation. The analysis reveals a scenario that is professionally challenging due to the nuanced application of Regulation D, specifically Rule 506, in the context of private placement offering in California. The challenge lies in accurately determining the number of non-accredited investors and ensuring that the offering strictly adheres to the limitations imposed by Rule 506(b) to maintain the exemption from registration under the Securities Act of 1933. Misinterpreting these requirements can lead to significant regulatory violations, including the rescission of the exemption and potential enforcement actions by the Securities and Exchange Commission, SEC, and the California Department of Financial Protection and Innovation. Best professional approach involves a meticulous calculation of the number of purchasers, distinguishing between accredited and non-accredited investors, and ensuring that any non-accredited investors meet the sophistication requirements outlined in Rule 506(b). This approach prioritizes strict compliance with the regulatory framework. Specifically, for an offering under Rule 506(b) that does not involve general solicitation or advertising, the issuer can sell to an unlimited number of accredited investors and up to 35 non-accredited investors. Crucially, each non-accredited investor must, either alone or with their purchaser representative, have such knowledge and experience in financial and business matters that they are capable of evaluating the merits and risks of the prospective investment. In this scenario, the calculation must confirm that the total number of purchasers, after accounting for any joint purchasers and considering the sophistication of the non-accredited investors, does not exceed the 35 non-accredited investor limit. This rigorous verification ensures the offering remains within the safe harbor of Rule 506(b). An incorrect approach would be to simply count all purchasers without differentiating between accredited and non-accredited investors, or to assume that any investor who can afford the investment is automatically sophisticated. This fails to recognize the specific qualitative and quantitative limitations placed on non-accredited investors under Rule 506(b). Another incorrect approach would be to rely on the general solicitation provisions of Rule 506(c) without meeting its heightened investor verification requirements, or to assume that because the offering is limited, it automatically qualifies for exemption without adhering to the specific purchaser limitation. A further incorrect approach would be to overlook the requirement for purchaser representatives for non-accredited investors who may not meet the sophistication test on their own, or to miscalculate the number of purchasers by not properly accounting for joint purchasers. Each of these missteps constitutes a failure to adhere to the precise requirements of Rule 506, jeopardizing the exemption. The professional decision-making process for similar situations should involve a thorough understanding of Regulation D and its specific rules, particularly Rule 506. This includes a detailed review of the definition of accredited investor and the sophistication requirements for non-accredited investors. Before proceeding with any private placement, a careful assessment of the potential investor base and the offering structure is essential. When in doubt, consulting with legal counsel specializing in securities law is paramount to ensure compliance and mitigate risk.